Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And I should mention that I noticed that almost 500 people have downloaded the 97-point financial health checklist, which is great. And I hope you've got plenty of value from, some of those points. I think even if it gives you one idea, it's probably worthwhile. So, of course, the link is in the show notes for anyone that hasn't downloaded it yet, but I hope it's been useful for you. Okay, so let's get into some listener Q&A. Got some really good stuff for you today, so I hope you enjoy it. Look, the first one I want to address is a response from Sam, and I answered a question on the 26th of August, one of Sam's questions, and he wrote me a long email, and I'm reluctant to convert this podcast into a conversation rather than a Q&A, and I guess Q&A, a better way of explaining or describing Q&A, it should be questions and opinions, because really all I'm sharing is opinions, not necessarily answers. I think we've got to leave room for the possibility that there's other ways of achieving wealth other than what I'm talking about. My views are based on almost always on evidence. So I think it's the best approach because I can cite the evidence behind the approach. But I'm not arrogant enough to believe that there's only one way to do things and possibly there's another approach. In any case, I wanted to sort of keep it not too conversational because otherwise you end up going down rabbit holes. But Sam's response was so compelling that I really wanted to actually respond to it. And it's a really long email, so I'm not going to read it out, but I'm just going to sort of summarize the points. And the main point is that he's told me about three properties that he owns, three investment properties. There's one high value blue chip property and two regional properties. So the two regional properties are worth $550,000 each. They're high yielding properties, around 6% gross rental yields. And he estimates the negative cash flow from holding those two assets is about $14,000. I don't know if that's before or after tax, but that doesn't really matter. I suspect it's probably before tax. And he compares that negative cash flow. So that's $1.1 million of exposure costing $14,000 a year to hold. So that's negative cash flow, of course, compared to another asset he's got, which is $2.2 million at a much lower LVR. So he's got less debt against it, 50%. But if it was running at an 80% LVR, so make it sort of comparable with the regional properties, it would cost $56,000. So really we've got 1.1 million in regional. If we double that to make it perfectly comparable to the blue chip property, which is worth 2.2, then instead of 14, it would cost 28. So I guess what we're doing is comparing the negative cash flow from these assets. One's costing 28 and one costing 56. And I hope I've understood Sam's commentary there. And his observation is that, even if the regional properties only grow at 5%, because they're costing him a whole lot less to own, conceivably he could go and own and hold 7 of those properties if he got rid of the blue chip one. And even if they only grew at 5% in terms of capital growth, that would still produce pretty good outcomes. I think he's suggesting the same or maybe slightly less than owning a blue chip property. So it's a bit long-winded. The whole email is quite lengthy, so it's hard to sort of summarize it in a very short period of time. But Sam's thesis, or the question Sam's putting to me, is why wouldn't I go and invest in these regional assets? Because I can hold more of them. And I guess the argument there is you've got more diversification. And if you have a vacancy, which it's unlikely in this market and in the foreseeable future, but if you have a vacancy, you kind of minimize it and all 7 are going to be vacant at the same time and get some geographical diversification as well. You can probably avoid paying land tax because, they're lower value assets and you can spread them across a couple of different states. He also made the observation that some lenders, if you buy these properties in a family trust and they're self-servicing, which means that their income is enough to pay for their rental, that those lenders will ignore the debt because it's in a separate entity and it doesn't rely on your income to be able to service it. And so that was an additional point of potentially, buying these regional properties. So I hope I haven't lost you there because it's a long sort of preamble to get into the answer. If you force me to summarize it in a sentence, should we go and buy higher yielding regional properties, even if we acknowledge the capital growth is going to be lower, because that extends our borrowing capacity to allow us to hold on to more assets and get actually, at the end of the day, greater exposure because 7 of those properties, for example, is $3.5 million. So it's a great question. You can see why I wanted to respond to it. Well, let's look at some of the assumptions that Sam is using. He's saying a 6% gross rental yield, and let's assume that the capital growth rate is 5%. So this investment strategy then is premised on the idea that my total return is 11% over the long term. If I'm going to hold these assets for 30 years, I'm going to get 11% return per annum from regional property over the long term. I don't think that there's any asset class in the world that I would build an investment strategy around assuming I'm going to get 11% total return. I just think that's too high. I think it's too risky to base an investment strategy on that. I would probably go with 9% or lower, which means you've got to trim off 2% from somewhere. So either your growth rate's going to be 3 or maybe your rental yield's going to come down over time. But I think 11% isn't correct. And look, I think you've got to be careful about extrapolating medium-term performance and then thinking it's repeatable. So obviously regional's been through a bit of a boom through COVID. Okay, it's come off a little bit since COVID. But interestingly enough, I was listening to Louis Christopher from SQM, and he was saying that rental vacancy rates in regional areas are tightening again, so falling. So, maybe that market's still relatively healthy. But the problem is if you go and have a look at 10-year data in any regional location, be it specific assets that have been bought and sold over that period of time, or just as median data, suburb data, or local area government data, it's going to be skewed a little bit. Well, it's going to be skewed a lot, I should say, from the COVID boom. So I wouldn't be saying, well, 10-year data says the growth is 6%, so 5% should be okay. I would be looking at data over a 40-year period, and I'd be trying to build a pretty compelling data set. So I wouldn't necessarily just go and look at one suburb or one location and think, yep, it ticks the box. I think you need to build a wider data set there as well. So what do I believe then that's going to happen? Well, I believe if you've got a property with a 6% gross rental yield, I believe your growth is going to be inflation or maybe slightly below inflation over the long run, right? So I don't think 5% growth is the right answer there, and compounding capital growth is just not really going to work. The other thing too is it's not a game of the number of properties, and it's also not really a game of the gross amount you've invested in properties. So as I said, 7 times $550,000 is $3.5 million. It's not about trying to leverage up as much as possible to buy as much property as possible. It's really a combination of quality and quantity. But I would say quality is more important than quantity. So I would rather own one fantastic $2 million asset than 7 average assets for $3.5 million. And you might say, well, Stuart, if I put it into a spreadsheet, you're wrong because the $3.5 million is going to yield a better answer. Well, of course it will. I acknowledge that. And of course it depends on the assumptions you put into that spreadsheet. But there's 2 things that go into an investment return: risk and growth, right? So we can't if you're just focusing on the numbers, all you're doing is focusing on the growth, you're ignoring the risk aspect. And the reality is that regional locations are a lot more risky because supply and demand is completely different in regional locations. In regional locations, land supply typically isn't a problem. Access to vacant land, you drive sort of 10, 15 minutes. In any direction, you'll find an abundance of vacant land. So the land supply problem is a challenge. And then just employment and job opportunities and those sorts of things. And yes, we can talk about work from home and flexibility and those sorts of situations, but the reality is that the capital cities provide a lot more diverse employment opportunities and will attract higher income earners. And those higher income earners are the ones that are going to be driving property prices over the next 2 or 3 decades. And that's kind of where I want to be investing, for example. Also, 7 assets are a little bit of work. We can't ignore, investing in the share market's really easy, right? There's no sort of time required in order to do it, particularly if you're using the approach that we use in terms of low-cost index funds. But property, let's acknowledge it, they can be a pain in the neck at times. A tenant, an issue, a maintenance request, etc., etc. Multiply that by 7. We can't underestimate the hassle of looking after property. Now, I'm not saying it's going to be a hassle, but the tenant profile could make it a hassle because of the price point that you're getting into. And what I would say is I would say there's a much, much greater risk of that occurring. Whereas if you've got a typical higher income earner tenant, they tend to be lower hassle than other demographics. And my last comment would be really related to the credit policy situation, which is, look, my strategy is to go and put all these properties in family trusts, get them self-servicing so that I can extend my borrowing capacity. That strategy, again, is premised on more is better, which I don't think necessarily that's the case. We shouldn't be going for, I want 10 properties or I want $5 million invested in property. That's not my aim. My aim is to maximize the equity over the next 20 or 30 years. And I might be able to do that with one great asset. But also, over the time I can share, I've been in this business almost 23 years in November. I've seen a lot of different approaches talked about with respect to investing in property, a lot of them based on credit policy. There was one policy before the GFC where a particular lender was targeting living off equity. So that is, they were targeting investors that had, a lot of property, a lot of equity in property that was negative cash flow, allowing them to borrow against that property to fund their living expenses. And that strategy was called living off equity. And it didn't last that long. Of course, we had the GFC and that knocked on the head. And a lot of people got in a lot of problems as a result of doing that. So I would just be careful. Look, I don't think I'd be swayed too much by that strategy of saying, well, if I've got a property in the entity, then I can ignore the debt. I don't think that's really the answer. I don't think that's really necessary for most people. Again, if you've got the right strategy. So it's a long-winded answer to Sam's question. Although it's specific to Sam and his question, I thought it was interesting. It's something that continually comes up. The difference between blue chip investment grade assets that are located in well-established suburbs in capital cities versus secondary suburbs in the outlying areas in capital cities versus regional. And it's something that's always going to come up. And I think there'd be a lot of people at the moment that could point to evidence for themselves that they've done well out of investing in regional. And that's fantastic because I think, the timing aspect around regional purchases could have been perfect in the last 5 to 10 years in many regional locations has been great in terms of growth. But I've got to remind everyone, remember, property is a long-term game. We're investing in property to benefit from compounding capital growth. Compounding capital growth, not income, will drive all the return. That's the aim. That's the numbers, right? And, that's very much the goal. So you've got to think about this location I'm investing in. Do I think it's going to continue to outperform over a 30-year period? And what fundamentals then can I cite to support that view? And that thing that I would put to people. So again, long-winded, but I think it's a really interesting discussion. And so the next question I'm going to talk about is from Solomon, who actually emailed me a question in March 23 before I started doing these Q&As. And he just reminded me that, hey, you never answered that question. So of course, I'd love to have a go at that. So essentially, Solomon says that if he owns a $1 million investment grade asset and it grows at 8% compounding for the next 50 years, it's going to be worth $46 million, which is correct. And essentially, Solomon's question is, how in the hell could it be worth $46 billion in 50 years? And he puts to me that surely property can't keep growing at that rate because mathematically, at some point, we're just not going to be able to afford to own property. And I don't disagree. Now, 46, it'll be almost 47 million, 46.9 million by my calculations. At 2.5% inflation, that's $13.6 million in today's dollars. So firstly, we've got to think about those numbers, particularly over a very long period of time, excluding inflation. If inflation was 3%, it'd be closer to $10 million. So I guess from that perspective, will a property be worth 10 times more in 50 years? Well, it's possible. I mean, it depends on the property location, all those sorts of things. It's not impossible. 50 years is a very long period of time. And I think if you look back in real terms of what property's done over the last 50 years, probably almost anywhere in Australia, I think most properties are going to be around about 10 times higher in value today than what they were 50 years ago. Now, the broader point though is, can Australia continue to grow at this rate? And I remember meeting a financial advisor from the US many years ago. It would be more than 15 years ago. And we were talking about our approach to financial planning and the modeling and the assumptions that we use and those sorts of things. And they couldn't get their head around property prices in Australia and property growth. And that really sort of stuck with me. Look, I think the answer is that no, property can't continue to grow as it has over the last 40 years. And it kind of leads into my point or relates to my answer to Sam's question as well. At some point, almost every property in Australia needs to level out in terms of growth. I think those outlying areas are going to level out a lot sooner than what, blue chip areas have. And I've spoken before in other episodes about, investing in areas that aren't necessarily just linked to family income. So investing to areas where there's business owners, people that are receiving inheritances. Another big one lately, employee stock, white collar professionals that work for listed companies, particularly even US tech companies, get a lot of stock given to them. And that's something that's been a bit more prevalent, I reckon, certainly by my observation over the last 5 years. So that doesn't necessarily reflect in income figures per se, but it certainly helps drive property prices and capacity and those sorts of things. But of course, mathematically, even those areas, it's going to level out. I don't think the blue chip areas are going to level out in my lifetime. Pretty confident about that. Pretty confident they're probably not going to level out in my son's lifetime. They're both 17, but they will eventually, I think, in future decades. But it's a really good point to really think about, well, if I'm going for growth, mathematically, can property in a regional location or outlying location, mathematically, will those people, the demographic that live in that area, will they be able to afford to pay 10 times more or whatever it might be? And it's a great question. So I don't know if I've answered that, Solomon, for you, but at least that's my view. It's a bit hard to sort of crystal ball gaze in terms of what might happen over the next 50 years, but it is a very good thing to think about. And I think about that topic quite often. Okay, let's get into back to, I should say, some more current questions that I've received. So this one is from Tom. Tom says, my question is, should you leverage into property as much as possible? It's funny that this actually, and only just randomly, kind of relates to the previous two answers as well. But anyway, Tom goes on, even if that might mean needing to sell the investment property to upgrade your primary residence in the midterm. His question arises because recently he was advised he could borrow $700,000 to $800,000, which would enable him to buy an investment property. His financial circumstances are unlikely to change materially in 5 years' time, but it's possible in 5 years' time that he may need to sell the investment property to upgrade his primary residence, as he will have a second child. I imagine he'll need more accommodation at that point in time. So Tom, it's a really good question. Should you buy a property now, even if there's a risk that you might need to sell it in 5 years to reach your personal goals? Well, the power of leveraging into property, and I've done these numbers that it sort of achieves around about a 13% compounding return, is that your only contribution to owning that asset is paying for the holding costs. So that is, I go and buy a property today, borrow the full cost of that asset, and then the only contribution really I'm going to make to that investment is the holding costs over the period of time. And as I explained in a recent podcast, that might persist for 10 to 20 years in terms of that negative cash flow. And hopefully then if I buy for $1 million in 10 years, that property is worth 2, in 20 years it's worth 4, in 30 years it's worth 8. And so in over a 30-year period, I've accumulated $7 million of equity in that asset. And my only contribution, as I said, is the holding costs. And that's how I can achieve such a high return, 13, 14% compounding, because of that leverage. The power is not just due to gearing, it's due to time. You need gearing and time. Now, if you take the time element away, the strategy just doesn't work. So my answer to your question, Tom, is no, I wouldn't buy a property today if there was higher than, say, 20 or 30% probability that I would need to sell it in 5 years' time. I just don't think you're going to net of holding costs, the risks of markets moving, that's very unpredictable. I just wouldn't do that. What I might put to you though, Tom, what I would consider doing in your situation, I don't know your numbers, of course, so I don't know if this is possible. What I would consider doing is taking that $700,000 to $800,000 of borrowing capacity, and I don't know if this is possible, going and buying your upgraded family home today and putting a tenant in it for the next 5 years and enjoying the negative gearing benefits of that asset and then moving into it in 5 years' time at that particular point in time. Now, I don't know if your borrowing capacity allows you to do that or if there's a way that you can manipulate it so that you're able to do that. But that could be something worth thinking about it. But remembering, folks, that borrowing to invest in property, there's really 3 key elements. You need 3 key ingredients. If you have these key ingredients, you'll make a lot of money. Great asset, lots of leverage. When I say lots of leverage, you're borrowing the full cost and time, many decades. Tick those 3 boxes and you'll build a lot more wealth probably more wealth than 99% of Australians will ever enjoy. Okay, the next question is from Jane. Pretty simple one. Jane has a question around voluntary super contributions. She says, I'm in my early 40s, single with a mortgage that costs $3,000 a month. I've got $300,000 in my super and I make an additional 5% contributions in addition to the employer contributions of 11.5%. She's also got 2 investment properties that are just about to come off fixed rates. She would prefer to put the $400 a month that she is currently contributing into super towards managing the investment mortgages for the next 12 months until interest rates settle down. And she's asking, are there any disadvantages in doing this or taking this approach? Jane, no, I don't think so. I don't have any concerns as long as there's 2 things are true. The first one is that you got good cash flow management. That is that and the way that I define that is that you're not wasting money on things that you don't enjoy. And so, that you're therefore making smart decisions with your money. Now, I'm not saying that means spending as little as possible. Of course, if you enjoy eating out once a week, go and do that. But, if you're paying for Netflix and you never watch it, to me, that's a waste of money, right? So good cash flow management means you're not wasting money on anything. So you're making some good, deliberate decisions. The second observation is that it's completely fine to change your allocation towards investments during periods of time where interest rates are high, as long as you make the same change when interest rates are unusually low. So unfortunately, that's probably, a lot of people haven't done that during that COVID period where fixed rates were really low. We saw it in the numbers. A lot of people were spending, eating out, travel, accommodation, all those sorts of things went nuts, right? But during those times, and maybe I should have done an episode on it in hindsight, during those times, you should say to yourself, well, I'm getting a bit of a free kick here. Interest rates are lower than normal, so I should increase my super contributions or I should repay debt a little faster. I reckon I would estimate maybe 20% of my clients have actually changed the amount that they're investing, say, in super contributions, additional super contributions, or more particularly investing in share market, regular investing as a result of higher interest rates. So it's fine to do that. It's one of the benefits of having that flexibility to sort of change those amounts, just so long as when interest rates are lower, you'll switch it around. And as I highlighted just in the last question, the numbers are the compounding returns from gearing into property, 13-14% in terms of your contribution. So in actual fact, making sure that you're in a position where you can comfortably hold on to those 2 properties, assuming that they're good quality properties, are probably going to deliver better returns than what your super will. Yeah, and that's 13-14% after tax, by the way, folks. So it's probably going to deliver better returns. So I'd rather see you hold on to those 2 investment properties, assuming that they're good quality, even at the cost of reducing super contributions. Thanks for the question, Jane. It was really good. Okay, the next question is from Mark. Mark says he enjoys the podcast, especially the Q&A sessions, and he suggested in the case study sessions that it would be helpful to mention the rough age of people. So when that question came through, I've now reminded myself to do that. So I will give you sort of the rough ages when we started working with them and their ages now. It'll give you a bit of context. So thanks for that suggestion, Mark. I really appreciate it. Now, Mark's got a really good question about share investing. He says that he's been dumb/lucky enough to do well out of some single shareholdings. And he's asking, when do you sell them? He says that Buffett obviously says the best holding period is forever. But for the average punter, if you're up, say, 50%, is it better to sell out and take the CGT hit and put the profits into an index, or let the winners run? He says, for context, I've got some CSL, Macquarie and Fortescue Metals, pretty cheap during the COVID period before I had much in the way of financial literacy, and he's done well out of them. Great question, Mark. Do you take a profit from your share investing? Well, let's think about Buffett, and it's interesting. A lot of people take Buffett's lesson. Sometimes Buffett talks about, what advice would he give to a individual investor, and then he talks about what he does. And we've got to think about that, because what he does is buy large shares of businesses with great management in great businesses and holds them forever, knowing that markets will move in cycles. That's quite different to me going and buying a couple of shares in CSL, for example. So yeah, the holding period should be forever, but we can't always draw what Buffett says and apply it necessarily to our individual circumstances. Having said that, I do agree a lot with what Buffett says, so I'm not diminishing that at all. In your situation, Mark, you admit it was kind of a bit of luck in terms of buying it. There wasn't a lot of sort of thought process behind it. So I would return to that. I would return to when you first purchased those investments, what was your initial intention? Was it to hold them forever, or was it something else? I think your answer answer would be that, you didn't really know what you were doing and you just thought you'd throw some money into the market and see how it worked out. Well, to me, that's not investing. That's speculation maybe, or sometimes you could call it gambling, but you've just been lucky, right? So it's a little bit like going to the casino and saying, well, I'll just play a little bit and see what happens. You're just doing the same sort of thing. Now, we all know that if you're up at a casino, that's probably the best time to leave, because if you hang around, they'll suck that money back out of your pockets again. And I'll probably give you the same advice. If you've been randomly lucky financially, that's great. Acknowledge it. Take that money off the table and put it into an investment that does have fundamentals. Mark acknowledges now he's got a bit more financial literacy with it, so maybe he would have made a different decision back then. Now, with respect to investments, particularly non-speculative investments, and I would say CSL, Macquarie and Fortescue, they're pretty good companies. They're blue chip companies, right? So my view with those sort of holdings would be, I'd form a view on the stock's value. Is it currently fairly valued? Is it cheap, so undervalued, or is it overvalued? Because if it's overvalued, I'd probably take some money off the table, right? Particularly if it doesn't have a lot in the way of dividends, because I'd consider the dividend yield of it as well. And depending on how overvalued I thought it was, would dictate how much I would sell. So if I owned a stock and it was trading at $20 and I thought really fair value was $10, I'm probably selling all of it. But if I thought it was $10 and it's trading at, say, $14, I'm probably selling maybe a third or something like that. But I would continue, if it was undervalued, I wouldn't sell it. There's no point giving away the farm, even if you have done well from it in terms of unrealized capital gains. So let's look at your particular stocks. And I'm just using this as an example, by the way, folks. So I don't necessarily want to receive a whole bunch of questions from listeners about, I've got CBA, should I sell it? But just to, I guess, explain out my approach. So with CSL, it's trading on a forward PE of about 32 times. It's pretty high, but not high really for CSL. It's always been at a forward PE of about 30 odd to 40 odd. It's currently trading at about $300 a share. My view on CSL is it hasn't done much over the last couple of years. It's just sort of bumped along. It's sort of traded in a range of like $280 to $320, $330. But if you look at the very long-term returns, it's been really good in terms of a stock. My view with CSL is if the stock goes over 330, I'd sell it. Fortescue's on a forward PE of 5.7 times. That either means the market doesn't really love it or thinks that the future maintainable earnings or the most recent earnings or what they're saying they're going to earn, they disbelieve. Of course, China's cooling a little bit, but I don't think I'm going to sell a stock at 5.7 times earnings. So I'd hang on to Fortescue. Macquarie's trading at just under 20 times earning, and our independent research provider Lonsec reckons it's overvalued. I would probably take profit from Macquarie. Macquarie is one of those stocks that could keep running, but I think if you're selling it at 20 times earnings, I don't think you're ever going to look back in the long run and say, that wasn't a good price to sell at. I mean, I think if you're going to invest in stocks and get 20 times earnings, I think that's pretty full value from my perspective. So I'd hold CSL, sell it because it is a little bit volatile. It does jump around. If it gets close to 330, I'd sell it. Hang on to Fortescue. I think the dividend yield on Fortescue is pretty good as well. And I'd probably reduce my exposure in Macquarie. But that just gives you an idea of kind of the approach to these sorts of things. But the goal should be over the next say 5-ish years is to take a lot of that money off the table from those stocks and put it into maybe some better, more fundamentally sound index funds. Okay, folks, it's a bit of a longer one today, but some really interesting questions, and I hope you enjoyed it. And until tomorrow, bye for now.